Hi everybody, Bill Polis here, and in this tutorial I'm going to teach you our instant options income conservative protective exit strategy that will get you out of a spread altogether with a relatively small loss when the market goes against the trade. Now, most of the time the market is not going to go against the trade sufficiently to activate this exit strategy. But the few times that it does, you will want to exit the spread. Now, with this strategy, you're able to exit an adverse trade at a dramatically smaller loss than the possible maximum loss as determined by the difference in the strike prices less the credit. So this is an extremely important aspect to the instant options income trading strategy, where we're going after very high odds trades with a very high success rate. But at the same time, we're not interested in taking the maximum loss in an adverse market situation. So by applying this strategy, you have the best of both worlds. You have the high odds of success on each and every trade, but at the same time knowing that if the market does go against the trade, you have the protective exit strategy to get you out with that relatively small loss. So I'm going to review some charts here to show you how this works. First, I'm looking at GLD. That's the Spider Gold Trust ETF using freestockcharts.com, an excellent charting software service. And here I've plotted the GLD. All right, now this first example is going to be a credit spread trade that expired worthless, allowing you to keep the entire credit. And then I'll show you an example where an adverse market move triggered the instant options income protective exit strategy, getting you out at a relatively small loss. Okay, this example here, let's go to Friday, May 10th. That's this day right here, where the market opened, and on that day you've got the new weekly options starting to trade the Thursday before, and on Friday we want to put our credit spread on. And in this case, considering general market conditions and our desire to have a high odds trade, we go ahead and put on a bear call spread. So what we're going to do is sell a 143, that's right in here, a 143 call, and buy a 145 call for protection. That limits our risk. And of course, we do that on every trade. That's why we're using credit spreads as opposed to just selling naked calls. So we're selling the call at 143, and we're buying a call at 145. For a net credit of 21 cents. So for one contract controlling 100 shares, that would be a credit of $21 against a margin requirement of the difference between the strikes, $2 times 100, that's $200 less the credit of 21. That works out to a margin requirement of $179, yielding a potential 11.7% ROI, return on investment, in 1 week. Now, what has to happen in order for us to collect that $21? The market must close the following Friday at or below 143. And in this case, you can see this is a great trade. The market fell very quickly here, and on the following Friday, it closed way down here around 131. So this was a high odds successful trade. On the other hand, if this market had reversed and moved higher, let's say back up in here and then here, we're still below our 143 level. And even if it had chopped sideways, by the next Friday, we still get to keep our credit of $21. But what if it moved above 143 in the next 5 trading days? What if it did that? What would we do? If it moved higher intraday, we're not so concerned about that. But if it closed above 143, let's say at 143.50, that's when we apply our instant options income protective exit strategy. What we do is simply exit the spread. We cover the spread on the open the following day. We would get out immediately on the following day. So you don't have to watch the market during the day. It's only if it closes above the short strike price. At that point, in order to cover that spread, it would probably be trading around 80 cents. And we would have to buy it back for 80 cents. So that would be a debit. We still get to keep the credit of 21 cents. So our loss would be 59 cents times 100, or $59. Now, of course, we're never happy about taking a loss. And remember, these are high odds trades to begin with. But not every trade is going to be a winner. That's impossible in any kind of strategy. You get the closest to being able to do that with the credit spread strategy. But we still have to protect against adverse market moves. And this is the way you do it. So if this were to happen, there's a high likelihood then once the market gets moving this way, it's going to keep going. And we don't want to wait for that maximum loss to occur. The maximum loss in this trade is $179. We're not going to wait for that. As soon as we get a close beyond the short strike price, we're going to exit the trade. In this case, around a $59 loss. Now, we can tolerate a loss like that when we're trading with high odds credit spreads. Okay, now let's look at an example where this actually occurred. Okay, in this example, we're looking at Goldman Sachs. We've got a nicely trending market. Nice move up here. And we identify this one as a good bull credit spread strategy. So as of the close of Thursday, this candle right here, we would be looking to formulate the right credit spread strategy to enter into on Friday, which is the red candle. So the trade here is to sell the 120 put and buy the 115 put for protection. So here's the 120 level right in here. And here's the 115 level right in here. So if the market closes at or above 120 as of the following Friday, we're going to be able to keep the credit. Let's identify the credit that we're pocketing when we put the spread on. So we're selling the 120 put. We're buying the 115 put for a net credit of 77 cents. So for 100 shares, that would be $77. One contract controls 100 shares, $77. Now, the maximum possible risk in the trade is the difference in the strikes. That's $5, or times 100 shares, $500, minus $77 credit, or $423. Dividing 77 by 423, we have a target ROI of 18.2%. Right in line with our criteria. Okay, so we enter into that trade on Friday. You can see the market closed lower on Friday, but then opened up on Monday and Tuesday higher, and all was looking pretty good. Then some unexpected news occurred, driving the market significantly lower on Wednesday, closing right in here, actually at 117.65. So that close was below our short put strike of 120. That triggers our instant options income protective exit strategy. That tells us get out of this spread on the open the next day. Okay, so the next day, Thursday, you can see the market opened higher. Right in there at 119.21. And at that price on that day, Thursday, with 2 more days, Thursday and Friday to go before expiration, we would have had to pay about $1.74 to cover that spread. Or for one contract, 100 shares, $174. And we're out. So, what was the outcome? We had to pay $174 to cover the spread. We still get to keep the credit of $77. So in this case, we end up losing $97. Now that's as opposed to the maximum possible loss of $423. You see the difference? So with this strategy, we can stand a losing trade from time to time and still have the expectation that our equity curve is going to go up over time. By the way, instead of applying the credit spread strategy, let's say you just went in and bought this stock, 100 shares on that Friday morning at about $125. A share times 100 shares, that would have cost you $12,500 to own that stock. Now ask yourself, what is the maximum possible loss with that position? Well, it's $12,500 because theoretically the stock could go to zero. But of course, you would never apply that kind of trading strategy. You would likely load in a stop, probably 5% or so below the entry price, which would be what, about 118, risking $7 per trade times 100 shares, or $700 risk. Okay, so I just want you to compare. The maximum possible loss of buying this stock is $12,500. The expected loss is $700. Quite a difference. With our credit spread strategy, the maximum possible loss was $423. Our expected loss was much less than that. In this case, $97. Okay, this is a very powerful strategy. You can put this to use in your own trading right now and dramatically improve your results.